Welcome to 20 Minutes of Clarity. I'm your co host, Jason Noble, and with me today I have Andy Merchant, and we're getting into an important topic, especially this time of the year, which is around proactive tax planning. Now, I will say, Andy and I, we are qualified financial advisors, but we are not accountants. So do not take this as tax advice. It's just we see this on an ongoing basis working with our clients and business owners and executives that have tax implications. And from a planning perspective, these are things that they need to do proactively. Andy, what would you like to add to that as well?
No, I think you hit it right on the head. At too often times, right? We get our clients that come in, and once you hit certain deadlines of the year, it's a matter of reaction and not being proactive. And part of our mission within the Clear Picture Wealth program is control, and we want to put our clients in as much control as they possibly can, so that they're not surprised. So I'm really excited today. You know me, I'm kind of the tax guru when it comes to planning and taxes. So
Yes.
let's I think this could be
We're going to
fun.
have
What do you
fun
think?
with this. And this is, I
Yeah.
mean, what a fun topic, right? But no, this is an important topic and we're going to dive right in. And there's going to be three things that we're going to be looking at in our conversation. One is understanding the different types of income and how does that play into the overall planning part. The second thing is understanding ways that you could have lower your income either through deductions or credits and things of that nature, which is such an important factor. And the third way is to really look at reviewing a tax plan as far as end of the year income that could be coming in, taxes, things that you could be doing for this tax year, but then also future tax years with things that are coming down the road and around the corner. So, with
Yep.
those things being said, let's start off with the first one. There's really three different main ways to get income. Can you share those with us, Andy?
Yeah, when we look at it, I think it's important for people to understand income, because with an understanding of one of our, your income, you're going to be able to better be more proactive in what areas that you might be able to take advantage of when it comes to tax code or better things in discussion with your CPA. So really, there's three buckets that we look at.
Mhm.
Bucket number one is going to be just earned income. You go to it's active. You're participating. You're going to your job. It has the least amount of tax deductions overall, but you are in the most control, right? To most degrees. So active is what probably majority of people listen to, and we'll talk some ideas around that. The second bucket, which I know is becoming a lot more growing in people's needs and wants and targets, is passive income.
Mhm.
Passive income can really come from a number of scales. It comes from everything from real estate ownership to limited partners, more of the accredited investor space. But even if you boil it down, dividend income on people's portfolio, their bank savings accounts, the rewards they get on their credit cards, those are all considered, passive income. Not all passive income is treated the same when it comes though to the tax code. But again, not giving advice is direction. And then the third one is benefits. When you're talking about benefits, those are usually your income that you have the least amount of control on it. So think about Social Security. Once you start it, it is what it is. You think about your pension income or your annuity income. So those are the three buckets when you're thinking about where your money is sourced from. I really help people just kind of jot down what is it active on my tax return, what part of it's passive, and then what is it my benefit income, and then from there we can start to look at clients and their tax strategy.
You know, I'm gonna ask a question. Like you said, like the distributions is something that you have the least amount of control on. Maybe I misheard that, Andy. But what did you mean by that when you made that comment?
Yeah, like when you're talking about Social Security, for an example, when you go off and you file for your Social Security benefits, it's not like you can have any influence it. If you're going with active income, maybe you can lobby for a raise, work a little harder, chase that bonus. Passive income, you could change your investment strategy when available, maybe to a higher yielding. But some of these benefits, annuity income, Social Security, and pensions, you turn them on, they're on, and then it's
Yeah,
up
they're
to
on.
their solvency of that. So you don't have a lot of control.
Yeah, and when I'm thinking about like Social Security, I think I'm not. Uh, a lot of people are not aware that Social Security can be subject to income tax,
Yeah.
and it could go up as 85% of your benefit could be subject to that tax. which is quite remarkable. And it could be rather a punch in the stomach when you first learn about it. So if you're learning about it now, I'm sorry. I'm already apologizing to you because I know I just knocked the wind out of you a little bit. But there's ways that you could offset that by having an appropriate approach for your distributions. We're going to touch on that as we get to the third section, is like, what can you do now to lower taxes? But then how do you start preparing to lower taxes in future years? So,
Yep.
I mean, not to jump ahead, it's just like one of those things that I find so important. And so I want you to like stay tuned and stick around to the end so that you could be able to learn some of those things today. So when you have that time, you can start making those proactive conversations and decisions with your trusted professionals. And then when I'm saying trusted professionals, I'm talking like your financial advisor, your accountant, your lawyer at times, right? I mean, but this is the thing that I will say is I'm seeing more and more of me and you, Andy, leading these conversations with our clients and less coming from the accountants. Not to say there's not accountants out there that doesn't do this. I'm sure there are. I just don't see it as often as I once did. Are you seeing the same thing in Wichita?
I mean, we're not. I mean, and I don't want to. This isn't a plug against your tax professionals that are out there. The reality is that most tax professionals only get what the client brings to them, and proactive, advice centric tax planning is not really something that's offered in the masses or as scalable. It's a lot of time. There's some expense to it, and you generally have to be in a niche, whether it's real estate or a business owner, to really get that services. So this is really more about what can you do as a client to bring the proactive questions to your CPA or your tax partner ahead of the year so that they can be, because the services are there. It's just not
So
something they
so
can
let's bring that to the front now. Let's talk about some of the ways that you can reduce your income through either credits or deductions. What are some of those things, Andy? And like, what are some of those questions that you were mentioning that we could be asking so that we could start getting those services?
I think you need to start with understanding the difference between deductions and credits.
That's right.
Deductions are going to be things that generally are going to reduce your income that you've earned, and therefore put you into a different tax bracket. So think 401ks. Those are deductions that you're getting off your taxes for a future payment. You could have your HSA. Is another type of strategy. You're paying less taxes on it today. So that's it's if you make 100,000, you put it. We'll just use simple round numbers, 20,000 into a deferred based strategy. You're able to deduct that income. Uh, the other side is that we have the standard deduction, and a lot of people may or may not be aware of the standard deduction that kind of changed the way that when we itemize. So when you do your taxes, we already have a standard deduction that's coming off, and not to quote the numbers, but it's a significant number. What people used to use was more itemized deductions in the past, but that's kind of really gotten a lot more limited. And we might not hit on that today, but it's really understanding deductions are things that reduce your income, therefore lower your taxes, where credits are going to be a direct offset of taxes owed. Things like child tax credits are out there, which are most of these are going to be income bases. But let's just say you owe 20,000 in taxes and you can find a $10,000 tax credit, then your taxes owed now is not 20, it's 10,000. So really understanding the two. But I think for the basis of most of our listeners and really just the tax environment right now, the standard deduction and having more of the deferral, donate, or type of strategy is really what most people are going to be looking for in their tax returns.
Andy, I think you brought up something that's really important. I just want to go a little bit deeper on. So we have what's called above the line deductions, and then we have below the line. I'll start by the easier one. Below the line deductions is a lot of people right now are using the standard deduction for the below the line. Okay. And it was just because of how much has gone up. But with the Tax Cut and Job Act coming expiring at the end of 2025, so in 2026, we should expect that standard deduction to go lower than where it is today. So then itemization may become very much way more popular than it is now. This is where speaking with a qualified advisor and accountant could have more of these detailed conversations. But above the line deductions, the most popular ones are your retirement plan contributions, like into your 401k or 403b or 457. That's an above the line deduction. Another thing that you could be looking at is student loan interest. Now, and with student loan interest, it's up to a certain amount, especially, and then from there, it's like income qualifications that come in there as well, right? So like these things come into play. Healthcare related expenses, so contributions into your HSA, health savings account, right, are fully deductible. But then, what kind of other healthcare expenses, depending on how much you're spending? I mean, these are things that come into play where it has to be very personalized and specific to you. So if you're listening, you're like, "Oh man, he's talking to me." Well, potentially, right? Maybe
Yeah.
you got to understand. I've not done an analysis, nor have Andy done an analysis on you specifically. But these are the things that you should be looking at yourself to determine, do you have this conversation with your accountant and your advisor, or does your advisor already have this information and bring this attention to you? And last but not least, you have business expenses. For those that are listening to business owners, this is not news to them, so I'm not going to spend too much more time on that, right, Andy? Why talk about, if you are a business owner and you don't know that your business expenses are above the line deduction, stop what you're doing, pick up the phone, call Andy, give us a call, okay? And so that we can have that more detailed conversation. Or just go to clearpicturefinancial.com and register your information so we can reach out and have that dialogue with you.
Yeah, I
But
mean,
I
it's all
want
about
to,
organizing it, right, Jason? I mean, it's organizing your income and then preparing yourself to ask those questions. I can promise you that nobody that's listening wants to pay more taxes than our fair share. And in many cases, we want to try to go below maybe our fair share. But the tax code was written for people to do that. And then there are two things I was just going to highlight real quick
yes.
as
Hmm.
we jump into that. These are a little one of those ones that if you've done this year, or if you're thinking about this, these are what to ask. Obviously, we all know about the big push of electric vehicles, right? And I think, Jason, I think you've got one in the garage plugged in here and there. But it's been a push. There are some electric vehicle tax credits. There are a tremendous amount of rules around that. So, one, if you've bought an electric vehicle, the first thing you need to do is look at it, look at the rules around it, and understand if you qualify for any of those tax credits on those. Secondly, if you're thinking about buying one, read the rules first, because certain cars don't qualify based on purchase price and everything. So if you're in the market for an electric vehicle or have purchased one this year, research it, then ask your CPA or your tax advisors what they're eligible for. So I think that's an interesting one, kind of top of mind right now in kind of our market and our world right now. The second one, which is less commonly known, and I just want to spend a second on this because you do need to refer to your tax advisor and do some proactive planning. If you owe taxes and you kind of have an idea. So, Jason, you mentioned business owners who generally are paying into through quarterlies or whatever we may do. We already have an idea as a business owner what our potential tax liabilities are. Um, if you work in some of your markets, there's these things called state tax credits. They're offered through certain investments. They're going to start, they always get kind of popping up right now because everybody's starting to say, well, do I owe taxes? But the quickest, simple definition of it is there's certain tax credits that are issued through maybe an investment. Someone makes an investment into a qualified investment vehicle that provides a tax credit. But that person, for example, like doesn't live in that state of where the business is providing the tax credit. So let's say Jason here, right? You go off and you buy into an investment here in Kansas, and they issue you this wonderful Kansas state tax credit. That's not going to do you a lot of good over there in Charleston, right, in South Carolina. And so, what a lot of the individuals with Jason could do is sell me his state tax credit, and so maybe he's got a $10,000 tax credit that he'll willing to sell it to me for maybe $8,500. He gets cash, I get it offset my taxes. It's a win-win. So there's a lot of CPAs may have those. So if you do have maybe a projected state tax liability, that's a question to ask if there's any eligible. And again, every state's rule by rule different. So that's why we said earlier this is not tax advice; it's questions asked. So I just wanted to throw those two unique ones out there for this call.
I love it, Andy. And also, you know, we mentioned in the first segment about the different types of income. You just touched into investments as well. So when it comes to the passive income, one of the things that I think that I'm very proud of, just the way that you and I look at this,
Hmm.
is on when it comes to passive investing, it's part of our three P's. And looking at passive income as part of the analysis in a Clear Picture Wealth program. However, they're all not built the same and they have different risk parameters. At a high level, can you touch on like how we start the initial due diligence on the risk parameters of these passive strategies? Because if you're listening and you're like, you know what, I need to start doing passive income strategies, but I don't know how to start, right? We're going to touch on it today. We're going to go into a little in another podcast down the road, more in depth. But Andy, you and I have put a lot of effort into this. Can you share at a high level what is a thing or things that people should consider?
Yeah, when we'll hit a minute of it. I think you're right. It's way more important for a future conversation. But the benefit of a lot of passive based investments is they can be structured. When you think about total return on a strategy, right, Jason? If we invest money, we're trying to get a total return, and that total return is made up of growth and or income. And in a passive investment income, that can be structured in what's called a preferred return. Think of it like a dividend of a stock, but it's a preferred return that, there's a lot of rules around it. That's why we don't have time. But if you were to find the right preferred return that is paying you income, and there's some tax advantages to where those could be treated as return of income. So it lowers your today bracket, but you'll have to recapture it, which is a whole nother fun conversation. But there's just some tax advantages that come with passive investments that you don't have. Dividend income is going to be the 20% standard dividend rate. There's some loopholes around making it higher or lower depending on your income. But overall, passive investments are going to do that. We look at them from a vetting standpoint to find ones that give you the most tax advantage passive income. And then, whatever growth is whatever your risk profile needs to be in time horizon.
And last but not least, we talked about some proactive things that you could be doing as you get towards the end of the year. One of those being, what is your projected income going to look like? I mean, these are the conversations that you're going to be wanting to have with accountants in November, early December. There may be a couple things that you could be doing, or at least considering, to lower tax implications if you're near a bracket. And so it starts with that. What is that projected income looking like?
Well, if you
Um,
don't if you don't know your income, how can you even know how much money you should contribute to your 401k for the end of year? Should you know about asking your employer if you get a year end bonus, is that eligible for deferral? Can you put it to a deferred comp plan? Right. And if you don't know where your bracket is, how are you going to know? How are you going to be able to work? This is where I get super passionate. How are you going to know when you're working with your advisor, if your advisor should be doing any kind of proactive tax loss harvesting, which is another conversation. So you have to know your income. Right now we're working with all of our clients and we're working with our CPAs to run year end kind of projections. Just ask the question, call your CPA, call your tax preparer. If you do your own taxes, you can do it yourself. Get your W-2 statement, forecast the rest of it, figure out some of your investments from your investment advisors, and just forecast where you think you're going to be. I think is just so important right now because we talked about credits, we talked about deduction limits, we did, and some other strategies. But if you don't know your income, you don't know if you qualify for half these things.
exactly right. Well, the other thing I'll say as far as being proactive on is I mentioned the Tax Cut and Job Act expiring at the end of 2025, going in. So 2026 tax code law is supposed to be reverted back. I want to say to the 2017 numbers, right, Andy? 2017, I think it was.
Yeah, I
But
believe
anyway,
so. Yep.
so what we're looking at is a lot of the brackets going higher, standard deductions going lower. There's a lot of changes that are going on with that sunset provision that was in the Tax Cut and Job Act. So I have I'll share this quick story, an example. I have this couple that they had a very low income this year. They retired at the beginning of the year, We were using assets in a tax efficient way to get that money to them so they could continue living the life that they want to live and do the things they wanted to do. But their tax liabilities this year are going to be really low. Great opportunity for us to consider Roth conversion. Had a meeting with the accountant last week to discuss the amount of the conversion. And it was interesting. I had to bring up the 2 year look back on IRMA for Medicare because I didn't want them to
Mhm.
go into the higher threshold. Um, and there's no way to know what that 2 year limit look back is until 2 years from now. So I just used the current numbers for this year. And the accountant was like, "I love this. Like, this is okay. This is the conversations that I've been waiting to have from my other clients' advisors." And I was like, "Well, I can't speak to them, but I could speak to the clients that I represent." And so we wrapped up that meeting, and I was able to circle back with the client over what we were looking at and why, and answer those questions. So we addressed the questions that they had and the ones that they didn't know to ask yet, right?
Mhm.
Well, the funny thing was, is I got a call from that accountant. He goes, "Hey, I was talking to another client of mine. It looks like we share the same client." That was that was funny
Wow.
to get that phone call because that particular couple that he called me on, I knew that they were switching accountants, but they wanted to let me know who they decided until after they made the decision. And I was like, "That's fine."
Yeah.
So I called the clients and I was like, "Hey, who did you decide to go with?" And sure enough, it was the accountant. I was like, "Hey, listen, him and I have other clients that we work with.
Yep.
You okay if we get into a more detailed conversation over the tax analysis?" So they sent me over their 1040s along with all the schedules. And I was able to use sophisticated tax planning software with them like I did my other clients. I can't wait now. And now that I got that report back, I can't wait to get that permission to share that report with that accountant and show the accountant, like, I'm not just doing this for some of my clients, I'm doing this for a lot of my clients, especially my business owners and executives, that we have more tax implications, more sophisticated tax analysis that we got to go into. I think it's going to show that this accountant in particular, that there are advisors out there like you and I, Andy, that will go just that we will go beyond just the balance sheet. We
Yep.
will go beyond just the investments and start looking at other aspects of people's financial lives, like their taxes, like their estate plans, like laws and regulations that come into play to help put more money in their pocket and less in Uncle Sam's. Andy, as we wrap up, what is the final word that you want to give our listeners?
Hey, let me give a couple words because I know we're going to go late. Year-end tax up. Make sure you're working with CPAs on tax loss harvesting. That's a 12/31 deadline. You can't do it next year and for this year. The other thing is if you're out there, required minimum distributions. We didn't go into the details, but make sure you've taken your 2023 RMD or 22, as that's going to kick up on there. If you've got any annual gift or deferred income or large 401ks. So those are the main things. Be proactive. That's my final word, Jason.
Well, that was Andy Merchant. I'm Jason Noble of 20 Minutes of Clarity. Thank you for tuning in and listening. We appreciate it. We'll be back next week.
See you later.